Hi there and welcome. Michael Beresford here from OpenCorp, and I'm here with this edition of Conversations with Matt, with OpenCorp CEO Matt Lewison. Great to have you here again in person, Louis. We've got a lot to share with everyone today. There's been so much talk in the media and the news around property investors and a negative sentiment, perhaps, given that rents are rising dramatically, and that can be the investor's fault, when it's really just supply and demand, playing out in a typical market cycle. Queensland land tax, there's been a lot of stuff talking about property investors. So my first question to you in this edition is, what is the role that property investors play in the market, and why is it important here in Australia?
Yeah, no, it's often overlooked, but at least 30% of households in Australia actually rent homes, and some of those renters are going to go on to become homeowners in the future, but many will not. And without property investors, and there's far more privately owned investment properties in Australia than there are social housing or institutionally owned. And by institutionally owned, I mean like super funds or so on. So the vast majority of privately owned rental homes. And without those, rents would be far higher, and there would be fewer opportunities for people to actually have accommodation in Australia. And obviously if rents are higher, people can't save for their deposits. It actually becomes harder to become a homeowner in the first place. So the more property investors that we have in Australia, the better it is for Australians in terms of keeping rent stable. And I think probably goes without saying, that's one of the reasons why the Australian government recently announced an accord to build 1 million homes. And while we've debunked that statement altogether, because we know that that historically, prior to COVID, Australia was actually building pretty close to 1 million homes a year anyway over a 5-year period, and it wasn't enough to keep up with population growth. But it just goes to show how important it is for the government. Like, they've got a real focus on this. A speech by the Deputy Governor of the RBA this week also highlights it as one of their main concerns. So when they're talking about obviously inflation, and there's a bit of discussion around energy, around food price inflation because of the flood. So the things that they can't control, the third is rents. The RBA acknowledges that they can't actually control rents. In fact, the more they put interest rates up, the higher rents are likely to go. And last 12 months, they've seen over 15% growth in face rents. So that's the rents signed up on new properties. So for new leases, 15% higher on average across Australia than they were 12 months ago. Now, they've only seen a pickup of 3 to 4% in the inflation figures so far, and that's because while the new rents are going up here, there's an existing volume of rents that were lower. So that's going to slowly creep up towards that 15% mark. Yeah. And they're very scared of that, and hence the reason why property investors and private rental stock is so important for Australia.
And I think that's the, there's opportunity anywhere, and it's really the lens that you put on it. So, if you kind of listen to the negativity, then it's very easy to be influenced by that. We're of the opinion that when you look at the fundamentals, which when you boil it down simply are supply, demand and affordability, the recipe is really very strong. And the case is very strong to be investing now and to be investing in what we call counter-cyclically. So, it's amazing when the newspapers and everyone's up and about and it's boom, boom, boom and property, and it's the best thing to be doing. But really what you're doing is buying the same thing as so many more people. And when demand is up, prices are up. So the value is actually far better in times like this, when you've got fewer buyers. You're being educated and understanding the fundamentals, and hence why we love this kind of content, being able to take and understand that, then apply it, most importantly. Who knows when, but at some point in the near future, the interest rate rises will stop. But I think to your point, the available rental supply in the Australian market, it's not easy to click your fingers overnight and provide another 100,000 homes. So property investors will continue to see dramatic rental growth for several years to come, which will far outstrip any holding cost fear that investors can carry around interest rates.
Spot on. And what we've seen in the last few months, particularly since the start of the year, is that housing starts and building approvals have been dropping. That means less supply starting to come through to the market. We're also seeing population growth increasing. We know that the overseas migration has been ramping up. We've only seen the first quarter figures from 2022, and they've hit a level that's higher than where they were pre-COVID. We know that the Australian government's increased the number of permanent migration places for skilled visas by 35,000 people. And again, even if we're aiming to build the same number of homes as we were building before, it should be an extra 35,000 bedrooms that we need to produce on top of that, just to cater for that extra 35,000 people. Now, student visa numbers are up. There's all sorts of drivers pushing that population growth, and we're seeing that ramping up at a time that supply is starting to dwindle. What does that mean? You don't have to look very far over the horizon to know that with where rents are going, there's going to be a lot of upwards pressure on prices through 2023 and into 2024. As a property investor and an owner of properties, I'll acknowledge that obviously, yes, higher interest rates aren't great in terms of cash flow on the face value. When my rents are going up faster than they've ever gone up before, like I'm pretty happy with that, and I know that that's going to stick around for a lot longer than high interest rates. So I think from an investor, you got to look forward, not the next 3 months. You got to look 6, 12, 24 months into the future at a bare minimum, because that's what your minimum investment horizon is, and you actually want to own for longer. So all these fundamentals are really rock solid for property right now.
I think it's a really good point, because when you've got record low interest rates, the cash rate's at 0.1%, people are paying 2 to 2.5% on a mortgage, you could buy the worst property in Australia and it would still be paying for itself, right? But when we've had significant interest rate rises, it becomes so much more fundamental to buy the right kind of property. And the kind of properties that we invest in and our clients invest in, we haven't had any client be forced to sell a property because they can't hold it, because the rents are going up dramatically. But the other key input to your cash flow is tax benefits. And you can tax deduct the interest that you're paying. And when you're really smart about how you maximize those tax deductions, then fully legally, of course, you maximize those tax deductions, then you're getting so much more back in rent, so much more in rent, and you get so much more back in tax benefit, which minimises that holding cost contribution, and hence how you can not only hold one property but hold multiple without it impacting your lifestyle or stressing your cash flow. So you mentioned a really good point. We've touched on a couple of things. There are so many more, I guess, headlines at the moment around the property market crashing and so on. But the feedback that we had from our client night a couple of weeks ago has been amazing around your explanation of the two different market cycles, top down and bottom up driven markets, how they're different, why they're different, where we've been previously and where we're looking over the next 3 to 5 years. So could you maybe just explain that for our viewers and the exciting part, I guess, of where we're at in the cycle right now?
Yeah, so we've just come through what we call a top-down market. And a top-down market can be great for making short-term profits, but it's also incredibly important to time it perfectly, because if you mistime a top-down market, you can be burned, to be honest. And so a top-down market is driven by essentially greed. So the top end of the market, when there's a lot of executives getting their bonuses, money's cheap and easy, it pulls the price up at the top. So they start bidding for the premium properties, of which there's very few. Yep. So they bid up the price, and then the second best properties start to look more attractive and so on, and that pulls the market up from the top. But as soon as you take away the thing that was driving their greed, the easy money, or the enthusiasm, the bonuses.
Endless positive sentiment, right?
As soon as you take away that positive sentiment, that pressure pulling it up diminishes, and all of a sudden there's now fewer buyers for those properties, and the market at the top end dries up. And you start to see a settling of property values. And we're seeing that at the moment with the median house price in premium markets, and even into the middle kind of to upper echelon of the Melbourne, Sydney markets in particular. We're seeing the median drop down because just those premiums properties in each suburb aren't selling anymore.
We saw it instantly, didn't we? Like our viewers based in Melbourne might be familiar with a suburb called Toorak. If you're in Sydney, think of a Bondi or a Mossman equivalent, something like that. Very, very top end premium. Your point about it ending very quickly is spot on, because in the first 3 months after the first interest rate rise, we saw the Toorak median come back by 15%. Yeah.
Well, we saw it through the 2017 to 2019 slowdown, which was obviously driven by tighter lending criteria from APRA. And I'm pretty sure Toorak dropped by about 34% in that period of time. So obviously that comes back really hard in terms of the median house price, and then it balloons really quickly when there's that really positive sentiment and as I said, greed.
Yeah.
Now, bottom-up market is actually driven by need, opposite to greed. And the way to describe that is, obviously there's a certain amount of housing stock in Australia, and there's a certain number of people in Australia. So regardless how many properties go to auction this weekend, it doesn't change the volume of houses in Australia, right? The only thing that's going to change the number of houses is building more. And the population is set by the number of births, deaths, and net overseas arrivals. When the number of people exceeds the number of homes and the number of households exceed the number of houses, then there's an undersupply of housing. That's a structural undersupply of housing. And we've seen that right across Australia right now. That's why the vacancy rate has dropped from 2 to 3% pre-COVID to 1% now. And in some cities, 0.5%. And there's, I think, it's 20% of the number of homes available going to market to rent right now as what was being put to market each week prior to COVID. So it's an 80% reduction in the properties going to or available to be rented on any given week.
One of our property, just sorry to interrupt you, but one of our property managers reached out to me yesterday. My lease is up for renewal early next year. There are 3 properties available for rent in a whole suburb.
Yeah. It's funny because one of the challenges we've got in property management right now is finding comparables, because nobody's prepared to leave their property because they're worried they won't get into a new one.
Yeah.
Hence the reason why rents are going up really quickly as well. So there's such a scarcity of that rental accommodation right now. That's proof in the pudding. There's an undersupply of housing around Australia. The only way to fix that undersupply is by either reducing the number of people coming into the country, and we know that's not really palatable for the government. Yep. There's a strong need for more workers, or by quickly increasing the volume of houses in the market. And you can't build a new house. You can't plan it, approve it, and build it in a day. There's a huge lead time for that, and we're underbuilding right now. In fact, the number of homes being built in 2021 was about 180,000. It's forecast to get down to 120,000 in 2023, and it's getting worse. Yeah. So bottom-up market. So we know that if there's an undersupply of housing, more people bidding for the affordable properties at the bottom end of the market, obviously they start to diminish, they dry up. So then they bid up the price on those affordable properties. So the next most affordable start to look cheap by comparison, and then people go, well, that's actually cheaper than I thought it was. It's not a big step to go from here to there, but I think the value is better. So then they start pouring into those properties and it pushes up the value. So that actually drives the prices from the bottom up, and it pushes them all along. Now, where greed disappears really quickly, what do we say? Greed fades, but need stays. It's not going to turn around. These market cycles actually take 2 to 3 years, maybe even 4 years before anything will be done. I touched on the Million Homes Accord the government wants to do. Now, they actually acknowledge before 2024, not a single extra home is likely to be built from anything that they do. So there's 2 years where nothing's going to happen. We would argue that beyond that, we think that there's almost nothing going to happen anyway, because an accord's a great thing in principle, but to increase the number of homes, they have to rezone a lot of land. That needs to be advertised. It has to go through public scrutiny. That takes years. Then once it's all done, developers need to buy it or go through the design process to then get approvals. That takes another couple of years. Then they need to build it, a couple more years. So it's 5 to 6 years if you started today at a sprint to increase the number of houses in the market. So great sentiment. I think it's unlikely to happen. And so this bottom-up cycle, and we're seeing it because the first home buyer loan approvals is starting to swing. It's a little bit choppy at the moment, but we're seeing that starting to swing around. And why wouldn't they? They've got government support, first home buyer grant, first home loan guarantee scheme. There's now state government incentives to co-invest with first home buyers. And again, if you're thinking about whether there's any, whether the government believes in houses, you just have to go, well, how much are they prepared to invest in the housing market? That tells you a lot. So all these things are supporting first home buyers, and their rents are going up at a rate they've never seen. They're desperate to get into that market, and there's few affordable properties, so they're driving up that price from the bottom. Doesn't make it into the newspapers. You won't see it in the stats because it's being hidden by the top-down market that ended, and that settling of the median house price coming down from the top. But we're absolutely seeing at the bottom end, we're still price growth happening in affordable suburbs, and we're seeing the rental growth. So as a property investor, again, we have to be really careful. You're not investing in the entire market, you're investing in one house.
Yeah.
And if if you're smart, you can get into the house that's going up in value, and you're getting a 1-2 year head start on those that sit out of the market, waiting until the median house price has stopped settling and go, oh, now must be the time to get back in. But they're really just catching on to that greed cycle that's driving from the top down, and keep in mind that catches the bottom last, whereas a bottom up is going to keep happening for the next couple of years. And that was always where I made money as an investor, getting into that bottom up, getting into the affordable end of the market, riding the price growth. And it's been a very steady 24 years of constant growth because of that bottom up approach.
You're spot on. I was thinking as you were talking that there are so many similarities that I see now to where it was post GFC. Government motivation to regrow an economy, commitment to population growth, especially first home buyer incentives. It's great to be on the positive whirlwind when everyone's flying, right? And everyone's up and about. The smart investors make their money when the demand is less, and you buy at the right time in the market. As boring as it might be, based on the fundamentals. And that's why that's what we focus on. I bought a property in the middle of the GFC. My mates told me I was stupid, the world was going to end, etc. In the 18 months after that, prices were up over 30%. And the reason for that was something that we wrote about in Investing in the New Normal, the government's investment in the housing sector, specifically in construction, given it's a major employer, to mitigate unemployment impact and to regrow construction economy. Then that's really a key thing. So that's one thing that we want to really reinforce is leave emotion at the door, buy based on the fundamentals, and the fundamentals make a lot of sense right now. So given that people are investing in one or 2 or 3 houses, depending on their borrowing capacity, not the whole market, and not all properties are created equal. Where are the opportunities? Where would you be investing in late 2022, early 2023? Where do you see those opportunities?
It's dynamic property, which is one of the things I love about it, and that you need to look, as we said before, a little bit into the future, not a long way into the future. You don't want to get too far ahead of it. But what we've been seeing in a trend has been a really steady reduction in vacancy rates. In Victoria is an interesting place. They're forecast to have 6.9% growth of population in the next 3 years. That's by far the highest rate of population growth. Now, a year ago, they had the highest vacancy rate. Now they're pretty much caught up with the rest of the country in the low 1%, and they're very shortly going to crack under that 1%. So while Melbourne's had been a bit stagnant, we see that starting to come out over the next 12 months. That population growth, to put it in perspective, the next highest is Brisbane or is Queensland at 5.5%. So 6.9 compared to 5.5%. That's at least a 20% extra kind of pace on the population growth coming into Victoria. So Queensland, high population growth, WA, high population growth at 5.3, and then you step down to New South Wales at about 4.6. So those 3 states, Victoria, Queensland, WA, really solid with population growth. Affordability in WA is still I'd say, optimum across Australia right now in terms of their affordability. They've got good rental yields, low vacancy rates, and a lower entry point. So for those looking to get into the market, and might be, if you're constrained on borrowing capacity, you're looking sub 700,000, WA, great place to be going. Where we can get into Brisbane sub 750, we think that's a good market to be in as well, in that sub $750,000 market. Now, there's a lot less opportunities there now than there were 12 months ago, and 24 months ago, because the base price has been rising really hard, particularly even in the last 12 months, while the middle and the upper end has been coming off a little bit after their really solid price growth. The bottom's rising and there's fewer properties and opportunities to get in that sub 750. So if you can get in there, that's great. And pretty much sub 800 in Victoria as well. Now, again, it's probably no surprise that these price points also match in with where the government support stops. So once you cross over 800,000 in Victoria, you're not getting first home buyer support.
Yep.
And as an investor, we're not going to get that either. But we want to invest where the first home buyers have got that extra support, because that's adding extra demand into that market. And that's obviously why those opportunities are diminishing really quickly. So again, driven by your price point is going to make a lot of your decision, where your existing portfolio is or where you might already live. We're big proponents for diversification. So if you've got a principal place of residence in Victoria, you actually might be better off to invest in another state. So you're catching the wave and you're kind of getting more stability to your growth. So they're really the three markets. Now, it's not to say that there's an abundance of opportunities out there. They're a lot harder to find today, but when you can get them, then there's going to be continued solid growth through 2023. And I think it's, as I said, an exciting time to be investing, because we know as soon as you get in, your rents are going up. You're going to be making more money next year than you made today. So, and probably just coming back to one other thing, we know that with the diminishing housing starts and the government's focus on trying to stimulate more houses, there's probably going to be something else that we see coming out through next year's budget. I wouldn't be surprised whether it's state, federal. There's going to be more intervention. They're going to try and promote and stoke activity. Now, the last time this happened was 2020, when the home builder came in. And I tell you what, I'd much rather have bought a month before home builder started, or 3 months before home builder started, than 3 months after it started, because the price of land, the price of building just went up instantly as soon as the government announced that. So ultimately, all of the incentive they gave went into the pockets of developers and builders because their prices just went up. But it created that momentum in the market, which did result in prices continuing to go up. So we want to get in ahead of these things. You don't want to wait and be a follower, because you're going to miss that opportunity. You're going to miss that 5-10% spurt that you'll get when these activities and these incentives and interventions happen.
That's so true. You know, we talk to a lot of people with our team here at OpenCorp, and often people say to us, we'll wait 6 months until things have come back. The reality is that by the time you hear about things coming back, there's already opportunity that you've missed out on. That's why at OpenCorp we take the education side of things so seriously. Finding these opportunities is really tough. You know, we've got a research and analytics team of 6 people. So if you're trying to do it after hours or on the weekend and you find that you're not getting very far, and you think that you could use some professional help to do that, please reach out. You know, we saw the market 2.5 years ago. We were talking to our clients about the opportunity despite the doom and gloom, and everyone that held a property through the last 2 to 2.5 years has made upwards of 200 grand. So if that sounds appealing and you'd love that in your portfolio, please reach out, get in touch. Matt, thanks again for joining us. We'll see you next time on Conversations with Matt.